Short exercise 5-4. So in this exercise, we will sell some merchandise and then process a return from a customer. But let's review some things first about sales returns. Revenue recognition standards say that when recording sales revenue, companies can only record sales revenue in the amount they expect to collect. Also, if the company is pretty sure customers will return merchandise to the seller, then the seller needs to estimate those returns at the end of the accounting period to show readers of their financial statements that 1. Some refunds will need to be paid to customers, and this is represented by the account called refunds payable, which is a liability. And 2. Some merchandise inventory will be returned in the future, and this is represented by the account called estimated returns inventory, which is an asset. So let's look at the account called refunds payable. It increases with a credit at the end of the accounting period as an adjusting entry. The credit amount represents the amount of future refunds we think we will have to pay to customers. The account decreases with a debit when we give an actual refund or allowance because the amount of possible future refunds is now smaller. Now let's look at estimated returns inventory. This is a current asset account and represents the cost of inventory that we think will be returned by our customers in the future. It is not actual inventory. The actual inventory is up here in merchandise inventory. So the estimated returns inventory account increases with a debit at the end of the accounting period when the seller estimates the cost of inventory that will be returned to the seller. The account decreases with a credit when the seller actually receives a return from a customer, lowering the amount of future returns because there is less inventory that can now be returned. So this slide, by the way, is just showing merchandising accounts. So we also have sales revenue. So anytime a merchandiser makes a sale, we're going to increase the revenue account. And also when they sell a product, we're going to lower the inventory account. So we would credit the inventory account and transfer that cost, because remember inventory is always at cost. We transfer that cost from inventory to cost of goods sold, which is an expense account. So basically we'd be taking an asset, inventory, removing it from a balance sheet account and putting it in the income statement account, in this case cost of goods sold. So for this problem, to make things easier, I've created some T accounts in Excel. I do this in Excel because I can't show you scratch paper. So I recommend you do the same thing on a piece of scratch paper to help understand how these accounts work. Now I'm going to make up some numbers and put them in the refunds payable account and estimated returns inventory account because that will help make the problem more logical. First, let's assume at the end of the previous accounting period, the company estimated that they would have to refund $20,000. So they increased the refunds payable by $20,000. This means the company thinks in the future they'll have to pay $20,000 to customers as refunds when the customers return products. Remember, I'm just making up this $20,000 number. It does not come from the problem, but the problem is assuming that there is a number there. Second, let's assume that in the estimated returns inventory account, at the end of the previous accounting period, the seller estimated that the inventory that will be returned to the seller cost the seller $12,000. Again, I'm just making up this number to help us understand this homework problem. And finally, let's assume that the inventory account that the company had available to sell cost $100,000. Again, that's a number I'm just making up. So the company has two inventory accounts, merchandise inventory and estimated returns inventory. So they have $100,000 of physical inventory available for sale, and they have $12,000 of inventory that they think will be returned in the future. But at this point, they only have $100,000 of actual physical inventory. So now that we have these accounts set up and we have some numbers available, it will make more sense when we work through it. So, journalize the following sales transactions for Thomas Sportswear. Explanations are not required. The company estimates sales returns at the end of each month. Assume the company uses a perpetual inventory system to record sales at the net amount. Click the icon to view the transactions. So we've got 2 transactions, but we really don't need it. We don't need that window because we've got the transactions here. Begin by preparing the entry to journalize the sale portion of the transaction. Do not record the expense, which is cost of goods sold. We will do that in the following step. So here on July 1st, this company sold $21,000. So we can put $21,000 in the debit and credit. For cash, cost of goods sold is $10,000. So whenever we sell something, we're going to get either cash or AR. In this case, we got cash. So this should be easy. So cash, of course, is an asset. And how do assets increase? Assets increase on the left side. So that's why I'm going to debit cash. Okay. And since we have a sale, we need to increase the sales revenue account. And how do revenue accounts increase? They increase on the right side. So sales revenue will be credited. Now let me move this up so we can see things a little better. So now that I've repositioned my window, let me check my answer. Well done. All right, now journalize the expense related to the July 1st sale. Cost of goods sold is $10,000. So what this means is we sold something that cost us $10,000 and we sold it for $21,000. So let's start with, if you wanted to post this $21,000 down to sales revenue, you could. And if you wanted to create a T account for cash, you could and post the $21,000 there. But I don't have T accounts for cash because most people understand that pretty well. Again, these T accounts are just to help us try to logic our way through the problem. Next, journalize the expense related. So what's happening to inventory? We had $100,000 and we sold some of it, and it cost us $10,000. So when we sell some inventory, we have to lower inventory. And which amount am I going to use? Well, remember, inventory is always listed at the cost. So the cost of the goods is $10,000. So we sold some product, also called goods. We sold them for, they cost us $10,000. We sold them for $21,000. So inventory is going to go down. So I'm going to go up here and then to the second line, because inventory is being credited, I'm going to skip the first line because the first line is supposed to be the debit. Debits before credits. So I'm going to go to the second line. That's inventory going down by $10,000. Put in the optional comma if you want. So then I can copy and paste that. So we got to figure out, well, what account is being debited now? So when we sell inventory, really what we're doing is we're taking the cost of the inventory, we're transferring it from inventory, so we're lowering inventory, and we're putting it into cost of goods sold. So the $10,000 goes from inventory, which is an asset account, and then it goes over here to cost of goods sold, which is an expense. And the expense, of course, is on the income statement. So basically what you're doing is you're taking a number off of the balance sheet and putting it on the income statement. So COGS is going to be debited by $10,000, the cost of those goods or products sold. So I'm going to increase cost of goods sold, also called COGS. Fantastic. Now, it says start by preparing, July 5th, Thomas received $6,000 sales return on damaged goods from the customer on July 1st. Cost of goods damaged is $3,000. Start by preparing the entry to record the sales return and refund of cash. So remember, this customer bought it for cash. So we're going to have to refund them cash. How much cash? $6,000. So we charge them $6,000 for the stuff that they are now returning. So in other words, we sold them $21,000 worth, and they're now returning $6,000 worth. So let's see. Well, first of all, let's start with cash. Since they paid cash for it, we have to refund cash. What's happening to cash? Well, cash is an asset, and assets go down with a credit. So the credit account has to be cash. Okay, so we know whatever the other account is, it has to be a debit. So remember, we're going to refund this customer $6,000. So we have our refund payable. Let me position this up here. So we have these refunds payable. So we expected in the future to have $20,000 of refunds in the future. Now we have had some $6,000 refunded, so the amount of future refunds, which was $20,000, has to be lowered. So this $6,000 is going to be lowering the refunds. And the reason it's being lowered is we now have fewer future refunds. Imagine if all of our sales were returned, then we could have no future returns. Therefore, our refunds payable would have to be zero. So we have $6,000 of refunds, so the future refunds has to drop. And remember, liabilities drop on the debit side. So refunds payable is going down by $6,000. So we now have only $14,000 of refunds that we think will be refunded in the future. So let me check my answer. And then our last transaction, now prepare the entry to update inventory account. So what's happening to inventory? Well, when we sold the inventory, it decreased the inventory. So when the inventory comes back to us, we have to increase inventory. So inventory is going to be going up by how much? $3,000. Now some of you will be saying, well, these goods are damaged, and since we bought these goods from someone else, like the wholesaler or the manufacturer, we will eventually have to return them to the manufacturer, but that's done in a separate transaction. So for now, the return of merchandise is going to increase our inventory account by $3,000. And then what's happening to estimated returns inventory? Remember, this $12,000, which was a made-up number, this represented the amount of future, the cost of future returns of inventory. In other words, we thought inventory that cost us $12,000 would be returned to us in the future. Now we have actually had some of this inventory returned to us, so that means we have to lower the estimated returns inventory because we now have less future inventory that can be returned to us. So the credit account is estimated refunds inventory. So let me go back to my T accounts. So that means after this transaction, we now think we will have inventory that costs us $9,000 returned to us, and we will have to refund customers $14,000 in the future. Let me check our answer. There we go. So to be able to make sense of this problem, you really have to understand how refunds payable works and how estimated returns inventory works. So remember that refunds payable are just refunds we think we'll have to pay in the future, and then when we actually have a refund, we have to lower the account. And the estimated returns inventory account is an estimate of the cost of inventory we believe will be returned to us in the future. And then when we have an actual return, it has to lower that account. And basically we're lowering this account and putting it back into actual inventory up here. So we're transferring it from estimated returns inventory to actual inventory back on our shelves. And since this was damaged inventory, eventually we'll have to return it to our manufacturer or distributor or supplier, whatever you want to call them. But that's it for this problem.